400K. Actually, no. Okay, so yeah, I don't think we need to read the top part, but basically Carly has net qualifying business income of 400K, so 20% of that is going to be 80K. Her taxable income is the same, right? So her 20% deduction supposedly would be 80K, but then because she's out of the range, we have to apply this 50% of wages or 25% of wages plus 2.5% roll on assets. So she has unadjusted basis depreciable assets of 1 million. So 2.5% of that is 25,000, and then she has 0 wages. So basically her deduction is 25,000 because 50% of wages would be 0, right? So the 25 plus 2.5 is 25,000, which is higher, and that's what she gets to take, versus the 80,000 that she, you know, if she wasn't out of the range, she wouldn't have been able. She would have been able to take 80. Do you guys have questions on that or want to walk through that?
So if you're above the top of the range, you don't get the 20% at all. You get a 50% of W-2s or 25% of W-2s and 2.5%.
Yeah, or yeah, the greater of the two.
That sounds pretty good.
The what?
If you give yourself a large salary, that would work out pretty well.
Right, but you would probably also,
Payroll tax.
yeah, also increase your, well, and then, yeah, I mean, you could also, like, this one thing is people were saying that maybe people might start converting independent contractors to salaries so that they can kind of utilize, like, the W-2 wages here, so, yeah.
This is total wages of the business, what the business pays in wages?
Yeah, business
Not
paid
your
W-2
personal
wages. Yeah, business paid W-2
Well, if you
wages,
have a
which,
C-corp and-
which could include your own wages if,
Right.
So this is W-2 wages of everybody in the company?
yes. Mhm.
Holy crap.
But again, it can't go over, so again, like her, there's gonna be an example later, but if it can't go over 80,000, which is 20%, yeah. So in that case, it would just be like, if you had a bunch of wages, then you just didn't get a reduced 20%.
It's a good thing they simplified this thing.
Right.
So it's capped at 80 then?
Because, yeah, it's capped at 20% of,
So
which,
it's
yeah.
the
Even is
lesser
the
of
example
that
here, it's
Yeah.
not a big
and the greater of the two, right?
Yeah, the lesser of the first set, right, and then the greater of the second set based on
But
W-2s.
that's only if you're above the top of the
Yes, that's only if you're above, yeah.
If you're below, sorry, if you're
Oh, sorry.
below, then it's just.
Are you an engineer?
If you're in between, it's a good.
Yeah, it's basically a proration, and then if you're above, then you have to apply this. But if you're a service-based business, you don't apply this, you would get just nothing,
Unless you're engineering services.
unless you're engineer. Yes, yeah.
We're all engineering services.
What if you're-
But this can't be W-2 wages of everybody. It has to be just the owner of the company, right?
No, it's W-2 wages of the business.
You're just fighting the 20, you're just fighting to get the 20% back, that's all. You can't, you're never gonna get over 20%.
Yeah.
Doesn't matter if you're paying them.
So this is the W-2 of the business, it doesn't include if you have like a spouse with a W-2?
Yeah, it doesn't include your spouse, it's your business's W-2 wages, not including all your employees in it.
Schedule C.
No, a Schedule C, if you pay, so if you're a sole prop and you pay someone a salary, then, yeah, then the W-2, how much you paid in salaries would
So
be.
which schedule would this be?
This applies to all
Employees.
employees of any business.
The Schedule C is just applied to your income, but if you had 20 employees, you would be giving them W-2s, so if you those numbers.
Yeah, and doesn't include subcontractors if, yeah.
On the depreciable assets, is that for business assets only? Or would that be like a Schedule C or Schedule E
Well, the
income
schedule,
property?
yeah, the schedule, yeah, this rule was actually made for Schedule Es. That business property assets was made to kind of include the Schedule Es, because usually Schedule E doesn't have wages. So they're compensating for that. by
So the
writing
C and E
taxes.
can kind of combine in this example,
You would calculate them separately, but yeah.
but the net would go together.
Yeah,
The-
yeah.
the
I mean, no,
or-
you would still calculate them separately based off all these rules, and then you would see what each gets, and then you would add those together. Yeah.
if you took advantage of the expensing option on assets, do you still need to use the depreciable value?
Actually, like if you did the like de minimis rules of 2,500 and under, is that what you're talking about?
Yeah.
I don't believe those would be considered assets because they're not on
I'm talking
here.
about the section 170, is it
But-
179?
Up to $10,000.
Yeah, if it's if it's 179, then it is still a depreciable asset. But there's another type of deduction that you can take, where if it's under 2,500 and you make an election and you expense that, then it would not count because it's not on as an asset. Yeah. Okay. All right. Okay. So moving on to the next person, and this is very similar situation, except she has 300K in wages. And no depreciable assets. So in this case, so basically 300K, 50% of W-2 wages is 150,000. And then if you take the 25% of W-2 plus the 2.5% of assets, you get 75,000, right? So in this case, the person would have, the higher of those two is 150, which is 50% of W-2 wages, but it goes over the regular deduction, so you only get the 80 that you would have, like, which is 20% of 400. Yeah. Is that clear? Okay. So the last example is just one where they have everything. They have the assets and they have wages. So basically 400K, 20% of that is 80,000. And then W-2 wages would have been 50,000, right? And then if you add together the 2.5% of assets plus the 25% of W-2 wages, you get 35,000. So in this case, they get to take 50,000 because it's the higher one of the two. Okay, all right. I think that's.
What's the lower of the 80,000?
Below the 80,000, so it's
Well,
the
because
higher
they're
the
already
total.
out of the phase-out range, yeah, so basically you're out of the phase-out range already, so then basically now you have to calculate it based off of the W-2 wages methodology, and based off of that, you get the higher of those two.
Right.
Yeah, yeah. Okay, all right, so this question was kind of asked already, but what if you have multiple businesses? So if you have multiple businesses, like for example, the fourth example has a law practice, a rental, and an S corporation. So the law practice is subject to the service-based business rules, right? So basically there's 0 for that. And then the rental is not subject to those rules. And the S corporation, which sells party balloons, also is not subject to it. So basically they just calculated everything separately, each business on its own first, based off of all these rules. And then you add them together, and then the deduction is 4,500 for the rental plus the S corp.
So if you don't have an engineering services business, then it would be better to have two companies, one that did pure services and then one that
Yeah,
developed products.
yeah. However, they are still going to come out with something to say if you have a mixed one, what will happen, they haven't said yet, so we're not sure about that. So they might do something so you don't have to go split up your corporation or your business. Yeah.
Questions? So this example, Carl has 4,500 total, so that comes off his 1040, like the second page, or?
It will be a deduction reducing his taxable income. I'm actually not too sure where it's going to show up, but it'll just reduce your income by that much. Yeah, by 4,500. Okay. All right. Okay, and the last example is actually just if you have business losses. So let's say you have two businesses. In this case, it's like I think a husband and a wife. The husband has a profit, and the wife has a loss. And then they also have a carryover loss from the prior year. You have to take all that into account. So basically what they did was the business that had a profit, the deduction would have been 30,000, but then the losses, you would subtract that from the total deduction. So, yeah, so I think you can kind of follow on the 5th page, but yeah, you would have to take it off.
That's strange. Why is that?
Well, I think the reason for that is you get to deduct the losses off of the income itself.
Oh, okay.
And so you
And then you're
can't,
gonna-
you can't add a credit, further tax credit on something where you've taken it all off.
So if I'm understanding this reduction on the NOL, it effectively they're phasing out NOLs faster than they were before, is that, am I understanding that?
They're actually not gonna allow NOLs anymore for 2018.
Any more NOLs?
Oh, sorry, no, sorry, they're not gonna allow carrybacks of NOLs, but they'll allow carry forward, and it'll only be 80% versus 100% of the NOL.
What's the NOL?
So, but do they
Net
deduct that
operating loss
20,
from, yeah,
do
so
they deduct 20%, are they looking to deduct 20% every year?
if you have an NOL carry forward, they will not they'll take a proration of that, 20% of that, and you have to deduct it from whatever your overall deduction is, your overall,
But if you're
20%
carrying
deductions.
a loss forward again and again,
Mhm.
you'll only be able to carry forward 80% of that loss.
Yes, 80%.
So every year,
and-
that's what
yeah.
I'm getting at, every year they're knocking off 20%. So
Mhm.
after 5 years, and regardless of how large it is, it's gone.
I mean, if you're already, they're not knocking,
Diminishing.
no, you can only take 80%, so they're not knocking off 80%, 20% every year. They're just saying, if you had a $100,000 loss, you can only take 80K loss going forward.
But you can carry the 20.
You can keep carrying it indefinitely, whereas before the rule was you carry it back, you can carry it back 2 years and then forward 20. But now it's no more back and indefinitely forward. Yeah.
So on this example of business loss,
Yeah.
it's, why is it being split up into earnings and loss? Because it just looks like the deduction ends up being 20% of the net.
Yeah, I think in this example, it comes out that way, but there probably are examples where it would not. It's just the math came out that way
Okay.
on this one. Yeah, so the thing is, like, just don't, I think yeah. Well, yeah, you could do it that way too, actually, because it's just a 20% on all of it, on all the losses. Yeah.
Or maybe it's like for the carryover, you take the actual, rather than just saying 20% of that, you take the actual that you were allowed to deduct in the previous year?
No, actually, it's the deduction that you're using in the current year that they're gonna, yeah, so if in the current year you take a 50K deduction, then they'll take 20% off of that, 20% of that and deduct it from your overall bigger deduction.
How far forward can you carry an NOL now, under the new?
Supposedly indefinitely until maybe they change it later, but yeah, at this
Oh.
point, yeah. And a lot of these provisions might end in 2025, so that's where sometimes maybe if you were to go change everything, it might go back or may not, so that's still all up in, that's kind of still, yeah.
Rental doesn't have to be in an LLC, it can just be a regular
Yeah,
rental.
yeah, yeah.
Okay.
Okay, so, okay, and then, so that kind of pretty much ends this part. I was gonna move on to deductions next. Unless there's-
Is there a name to this deduction at all? What do they
Well,
call
we
it?
call it 199 cap A,
199.
which is 199 and then capital A, but that's, yeah.
Okay.
Okay, okay, so moving on to deductions. So I was gonna just start with the DPAD, which is domestic production activities deduction. And generally this was a 9% of taxable income. It's 9% of taxable income or qualified production income, up to 50% of wages that you could have taken if you have a manufacturing company in the U.S. or you lease or license items that are manufactured in the U.S. or if you're a software company, and it includes video games. It doesn't include restaurants, but like construction companies would qualify for this sort of thing because they're manufacturing something in the States. That deduction is gone now, though, so they're taking that completely off.
The domestic production
Yeah.
deduction is gone?
Yeah, that's no longer available. R&D expenses, also, there's a change in that. So if there are R&D expenses, the rule now is that you can either amortize it or you can expense it right away when you spend it. Starting 2022, you can only amortize it. You can't expense it with an election anymore.
This is for Schedule C. I mean, this
If you
is
have
for
R&D.
a C corp.
This is, I mean, no, if you have R&D like as an S corp, there's also a deduction. Yeah, you can, yeah.
For
But
sole
you,
proprietorship also.
yeah, but usually C corps are the ones that have a bunch of R&D. So yeah.
What's the amortizable life that you amortize it over? And
so
is
for
it
you-
straight line?
Yeah, you could do straight line, but for US based, it's 5 years. US based R&D expenses, it's 5 years. Or it will be. Again, this is starting 2022, but then and then if it's outside of the U.S., R&D outside of the U.S., then it needs to be amortized over 15 years. Yeah. Okay. Okay. So depreciation, there's a change in that. It went for Section 179. Is everyone somewhat familiar? Or it's basically okay. Yeah. So basically, the 2017 the threshold, the max was 500K. Starting 2018, it's 1 million. So they've increased it, the limits on that. And then also there's something called bonus depreciation that people could take. And again, before it was like you could take in the current year up to 50% of depreciation on a certain asset. And before it could only be on new items. And now for anything purchased after September 27, 2017, it's 100% and it could be new or used. So this is something you might want to kind of just talk to your tax person about because it gets a little bit
Would that